6,438 options contracts on Oracle. Today, June 12. It is now 3:26 p.m. and Oracle will be reporting earnings after hours today. So that's in less than 1 hour. So we're going to analyze these unusual options to determine whether or not this is bearish or bullish, and then show you how we are trading Oracle for earnings. So let's get right to it. As you can see, this is expiring for June 23s, and this is the 114 puts and the 124 strike calls. So when we take a look at that chain here, June 23 expires in 11 days, and you can see here the 114 here is highlighted here, volume much greater than the open interest, and also the 124s are also much greater than the open interest. So we know these are opening orders. What's going on here is that they are buying the 114 puts and selling the 124 calls. And when we analyze this trade, you'll see that this is the trade. This isn't actually the price though. When we actually look at what they got it for, you'll see that the price difference here is about $70. The $3.95 and $3.25. So that's $70 difference. So when they executed this trade, it was $70. So we would have to put that down to accurately reflect their trade. And so this is the trade. You'll see here that Oracle is at 117, and as the price goes down on the x-axis, this trade becomes profitable. You'll see here, this is the zero line. Anything above is profit, anything below is a loss. You can also see that by the delta. It's a negative 74 delta. So that's bearish. Now, keep in mind that while this is bearish, it could also be a hedge on potentially a large investor having stocks of Oracle. And so that's something to keep in mind. You'll also see that as the price goes up, all the way up to here, their loss is still going to be that initial $70 that they paid. So there is a risk reduction over here, all the way up to about 124. You'll see this right here when the slope of this blue line starts to finally actually go down. When it's flat, that means their losses are maxed out, and it's going to stay constant at this negative 70. So this 124 is a key level. And so the way we are trading it is also based around this level here. We like that level as well. And we are not choosing the same strikes though. We are choosing the June 16th. It expires in just 4 days. And you'll see here we are selling the 127s and buying the 130s, and then we're collecting a credit of 52 at the current price, and then we are going to the June 30s, which is 18 days away, and we are buying the 114s puts and selling the 113 puts. And then when you analyze this trade, you'll see that this is our trade here. 4 options for this trade. And you'll see here our break even, which is these red lines here, at expiration, which is the blue line, is all the way to 127. So this stock can rally up to 127 and we would still not be at a loss. So we like the way we have reduced our risk, taking advantage of that volatility and selling the call spread. So this trade here can go down, or it could even go up, and we will be profitable on expiration, which is just June 16. And you'll see here, this is our Greeks. We are also a negative delta here. we also have a positive theta and a negative vega, which is good for earnings trades because we know volatility will contract, it will go down, so we want to have a negative vega. So we can put on many of these trades. This is just for one of these trades, it will require a buying power of about 300 because you'll see here we are selling a call spread here, which is about $3 wide. So that's $300 of buying power. And if you wanted to do a trade like this, you can adjust how many contracts you want, and decide how much you want to do. Depending on your risk tolerance and your how much buying power you want to use. The other trade that the unusual options, this large investor used, they were selling a naked call option here. You'll see here, this -1 here, that requires a lot more buying power, a lot more. So that's why we like to use our trade, where we are also able to shift our break even much higher to reduce our risk. And so the probability of our trade being a success is actually, you can see here, by expiration, which is June 16, we have there's only about an 11.6% chance that we'll be wrong, right? So it's essentially, we have about a 89% chance of being right, of the price being, this is the total of all these percentages, of being below 127, which is our break even at expiration. And so this is why we like to trade a little differently than the unusual options, these large institutional investors that trade. We are more profitable when we use these strategies. And if you are interested in how we trade with other stocks as well, we have more videos for members. If you're interested in that, these exclusive videos will help you learn how to trade unusual options. And just go to our our channel homepage, and there's a join button there to click to learn more. We do have a lot more other stocks as well, where we analyze unusual options, and you can get access to these videos so you can make better trades. You want to make sure you diversify your portfolio with multiple stocks if you want to have more success. And so that's why we do analyze and make trades based on other stocks as well, not just Oracle or Tesla or just the most popular stocks there are. We want to look for unusual options activity, trade based on those, and look at probabilities and the data, most importantly, as it comes in, and we adjust our trades based on that. All right, so hope this was helpful. If it was, please, as usual, give us a thumbs up. Helps us and encourages us to make more videos. And subscribe, click the bell icon if you haven't, to get notified whenever we detect unusual options activity. All right, comment below on what you think will happen to Oracle after earnings. We have less than 30 minutes left. Take care.